Hello and welcome to another TLC Tutoring Company accounting lesson. Today we are going to be going over some journalizing, posting, and unadjusted trial balance practice. So we are going to be doing this for a sole proprietorship. So this is going to be a service-based company with only one owner. Right? So step one, we are going to journalize 10 transactions for the month of December. So let's start with our first month. We have Devon investing $15,000 in his business, Marketings Plus Company. So for each of these, we are going to use this chart of accounts up here. Every account we need should be included. So really it's like a 10 account drop down list. And I'm also going to be utilizing this little cheat sheet off to the side, right? So Devon is investing $15,000 in his business. We will always do accounting from the business's perspective. So I know that cash is changing hands here. So Devon is taking money out of his personal account and putting it into a separate account just for the business. So from the business's perspective, cash, one of the accounts that's being affected, is increasing. Okay. So we've already answered half of it. We know cash is one of the accounts being affected. It is increasing. And I know that cash is an asset. One way that I know that cash is an asset, one is because I practiced this enough, but also I see that this account starts with a 1, so I know it's an asset. So how do I make an asset increase? Since we just determined that cash is going up, I have to debit that account. So I will debit cash. And how much cash? $15,000. Now, keep in mind, for every journal entry we do, we need at least one debit and at least one credit. So I know that there's a whole other side to this. So when Devon is making contributions to his business, and this works anytime you have a sole proprietorship or a partnership where the ownership is investing money, whenever they're investing, whenever they're making that contribution, their capital is increasing. So for the other side of this, what account is being affected? Devon capital. Is it increasing or decreasing? It's increasing. So contributions will always make capital go up. Devon capital is a capital account. And how do we make capital go up? We credit it. And I like to indent my credits. So Devon comma capital, just like it is on that chart of accounts, 15,000. So now you see we have at least one debit, at least one credit. We are listing our debits first, and the total of our debits equal the total of our credits. So we are done with that first one. If you're wondering what the post-ref column is all about, just leave it for now. We will come back to that. Let's do this next one on the 2nd. So on December 2nd, the company paid $2,000 for December's rent, right? So we are paying for the current month of rent. Let's kind of ask ourselves these questions. What account is being affected? I'm going to start with this. Paid $2,000. If we're paying $2,000, what are we physically giving? We are giving cash, right? So if we paid $2,000, that's the company's cash that is being affected. So, okay, so cash. Is it increasing or decreasing? Well, we're paying cash, so the company's cash is decreasing since we're giving it away. What type of account is cash? It's an asset. And how do we make an asset decrease since we just determined it was going down? We credit. So I know that on 12/2, my credit is going to be cash. Now, the reason why I skipped a line is because, important rule, debits first always. So we can kind of write this here. Debits first, always. So whenever you're doing an entry, if you come up with the credit, make sure that you're skipping enough lines so that you can fill in your debits. Let's figure out what that debit account is. We're paying for rent. Now, the important thing for us to determine is, are we paying for the current month of rent or are we paying for future rent, right? So in this case, we're paying for the current month's rent. So that means that we expense it right away. So we are going to record this in rent expense. Now, if this had been for a future period, we would have used prepaid rent because we're prepaying it for the future. But in this case, it's the current month. So rent expense is going up. As an expense account, we're going to debit it to record that, oh, we have this rent expense for this company. Let's move on to the 5th. Provided services on credit, $3,200. I want to start with this provided services part. Whenever we provide a service, we are basically doing our part of the contract. We just finished our requirement, our obligation for what we decided to do or what we agreed to do for the customer. So whenever we complete our obligation in a contract, we get to record income, revenue, right? So looking at this company, look at your chart of accounts and determine what account would we use for this revenue. We only have one revenue account here, services revenue, right? So there's one account that's being affected. And really the big thing to keep in mind here, provided services. That was my indicator that we get to record revenue. So revenue is increasing. We just performed the service. So revenue is going up. What type of account is services revenue? It's an income/revenue account. So how do we make it go up? We credit. All right. So same thing as the one we just did. I'm going to skip a line. Was that services? Services revenue. Okay. That was for $3,200. Now here's the question. We performed the obligation. Are they paying us now or are they going to pay us later? And notice this, on credit. That means they are not paying us now. We went ahead and said, listen, we'll do it on credit. You can pay us later. We'll invoice you. So that means that our customers owe us. So what account is being affected? Our customers owe us. What account indicates that our customers are going to pay us later? That would be our accounts receivable. And if you're struggling with this, it just takes practice. So accounts receivable indicates that our customers owe us money. We just provided service. So the balance of what our customers owe us is increasing. Accounts receivable is an asset account. So how do we record that that asset is going up? Debit. So debit accounts receivable. Okay. All right. December 11th, very similar. Provided services. So let's actually do that. Let's practice. Provided services. We know what account is being affected. Revenue. So we know it's services revenue. Our revenue is going up. Services revenue is an income revenue account. So we credit it to make it go up. So very similar to the last one we just did. So 12/11. Services revenue for $1,500. However, in this one, our customers are paying us immediately. We are receiving cash. So I know this debit is going to be cash, but let's analyze it. Cash is being affected. Our customers are giving it to us, so it's increasing. Cash is an asset. So let's apply ALSI. Asset going up, debit. But really, we could have just filled that in if we were feeling confident. Our next one is the 12th. All right. So I'm going to make this a little bit smaller. There we go. All right. So on the 12th, we purchased an annual insurance policy for $1,200. So this is actually kind of similar to the analysis we were doing on December 2nd. Paid $2,000 for December rent. We were paying for the current month there. Notice here we're paying for a whole year of insurance. So this is technically prepaid insurance, right? So let's analyze that part first. We are prepaying insurance for the year. So what account is being affected? Prepaid insurance. Is it increasing or decreasing? We purchased it, so it's going up, it's increasing. Prepaid insurance is an asset. It's a future economic benefit to us. So how do we record that assets are going up? We debit. So prepaid insurance. I believe it was $1,200. Yes, $1,200. Okay. So the other side of that, prepaid insurance, we purchased it for $1,200 and we paid it. So cash is our other account. It is going down. It's an asset. So how do we make an asset go down? Credit. So we will credit cash. So just to kind of compare it to the rent one that we just did, both times we were spending money on something. For this scenario, we were paying rent for the current month, so we expensed it right away. For the second one, we had a future economic benefit, right? This is a future value to us, so we made it an asset, prepaid insurance. Let's take a look at the 15th. Purchase supplies on credit. All right, so let's start with the purchase supplies part. So supplies is being affected. It is increasing. It's an asset. How do we make an asset increase? We debit it. So let's debit supplies. Let's see how much though. $600 of supplies. All right, so the other side of this. Did we pay for the supplies now? This is very similar to before when we were talking about, will we provided a service? Did we receive the money now, or will we be receiving that money later? In this case, now let's talk about purchasing. Whenever we buy something, we are either going to pay for it now or pay for it later. In this case, we are paying for it later. So what account is being affected when we say we're going to pay for it later? Accounts payable. Is it increasing or decreasing? So keep in mind, the accounts payable is telling us what we owe. So since we bought something, we're going to pay it later. The balance of what we owe is increasing. It's a liability. So how do we make a liability increase? Credit. So that's supplies and accounts payable. All right, let's look at December 19th. Received $1,400 from customers that were previously billed. All right, so received $1,400. We received money, so that would be cash. Let's just kind of stop there, right? So we received cash. It is increasing because we're receiving it. It's an asset. So how do we make an asset increase? We debit. So let's debit cash to show that we are receiving that cash. All right, and that was $1,400. Now, here is probably a little bit more complicated part. Why are we receiving this $1,400? The reason why we're getting this money is because we have customers that were previously billed. So in the past, we provided services and we billed them for those services. So what account do we use when we bill our customers? Accounts receivable. So remember, accounts receivable is the account that we use to show that our customers owe us money. Now on the 19th, they are now paying off what they owe us. So we already recorded that we received the cash, but now we have to record that the balance of what they owed us, accounts receivable, is decreasing. I'll say it again. So the customers owed us money and they are now paying us off. So accounts receivable is now decreasing because they are paying off what they owed us. Now, what type of account is accounts receivable? It's an asset. And how do we show that that accounts receivable asset is going down? We credit it. So cash and accounts receivable. All right, let's keep going. All right, paid $500 for purchases previously made on credit. Let's start with the paid $500, right? So if we paid $500, that's cash. It's going down. It's an asset. How do we make an asset go down? We credit. So let's make cash decrease. All right, now why are we paying this cash? We are paying $500 for purchases previously made on credit. So in the past, when we made these purchases, we said, oh, we will pay for it later. Perhaps it has something to do with these supplies we bought, right? So back when we went ahead and made these purchases, we put the balance of what we owed in accounts payable because we owed that money to the vendor. Now we are paying off 500 of this. So our accounts payable balance, the balance of what we owe, is decreasing because we are paying it off. Now, accounts payable is a liability. And how do we make a liability go down? We debit. So in my opinion, the 19th and the 21st, I think these are great ones to kind of compare. In this one, we received cash from customers that owed us. In this one, we paid cash that we owed to vendors. So you can see cash is going up, cash is going down. The balance of what our customers owe us is going down. The balance of what we owe is going down. So similar yet different. Let's do the 24th. We received a utility bill for $350 to be paid in January. Keep in mind, we're in December. All right, so received a utility bill for $350 to be paid in January. All right, so let's start with this. Received a utility bill that we're paying later. Let's start with the utility bill part. We already used up the value of this. This is a bill, so this is a utility that we've probably already used, probably for the month of December. So we are going to automatically expense that. So the expense is increasing. Keep in mind, just because you paid it, it doesn't mean it ever goes down. As you incur them, your expenses increase. It's an expense account. And how do we make utility expense go up? We're going to debit. All right, and either we're going to pay for it now or later. It says we're paying for it later. So what account do we use when we owe money and we'll pay it later? Accounts payable. It is increasing. The amount we owe is going up. It is a liability. And how do we make a liability go up? We credit. What is that? $350. All right. Last one, 31st. All right, so Devon is withdrawing $1,000 from his business for personal use. So he's taking money out of his business so he can use it for whatever personal expenses he has. So let's start with that. He took money out of the business. So what's happening to cash? Cash is going down. It's an asset. To decrease an asset, we credit. So let's start with crediting cash. All right. And now for the debit, whenever the owner takes money out of their company, we don't hit capital right away. We put it into this contra capital account. It's a special account called drawing, right? So this drawing balance is technically going up. And here's what's weird about it. Let me go ahead and put a little star here. It's a contra capital account. So Devon's drawing account is going up. It is a contra capital account. And how do we make contra capitals go up? So if you haven't heard about contras before, these signs flip. So to make a drawing account go up, we technically debit. So here's a note. Contra accounts make the signs flip. So if you ever encounter a contra account, then it's going to flip sides. And really, your first few chapters of accounting, the drawing account is the most popular contra that you're probably going to run into. So how do we make a contra capital go up? Remember, flip signs with a debit. So we're going to debit Devon, comma, drawing. Later, that will decrease his capital, but that's a story for another day, later in the accounting cycle. All right, so let's move on to posting these journal entries in the general ledger. Let's see. Let's make it a little bit. I'm going to have to zoom out just so that we can see everything. There we go. We're cutting it a little close there. Let me move this over. All right. So taking a look at each of these. We usually go chronological when we are posting, so I'm going to stick to chronological here as well. So line by line, that's what we're going to do. So on 12/1, we affected cash. So I'm going to go to the cash ledger and I'm going to put in that date, 12/1. I'm going to leave the item column blank. And I'm going to put that we are posting this on the first page of the journal. So I'm going to write J1. Now this first debit and credit, you're going to put whatever you did in your journal entry. So in this case, we debited cash for $15,000. So I'm going to put debit cash $15,000. The second one is our balance. Currently, we don't have a balance there, balance of 0. So our new balance is $15,000. So that part should be easy. Once you're done posting, you're going to post the account number from the ledger. So in this case, cash is 11. So I write 11 and that lets me know I posted it. I'm done. Let's move on to Devon Capital. So in Devon Capital on 12/1, again on the first page of the journal. Give me a second. That's going to drive me crazy if I don't do that. We credited the capital account for $15,000, which again, we don't have anything in these accounts yet. So the balance is simply $15,000. And this was account number 31, posted. Next one is rent expense on December 2nd. Rent expense, December 2nd, first page of the journal. And we debited rent expense for $2,000. Same idea. Bring the balance over. Just wait till we get another cash. Accounts receivable, or sorry, account number is 51. Sorry. So 51 posted. All right, now we have another account here. So when we have more than one, this is where it gets more interesting. So let's go to the cash ledger. On 12/2, on the first page of the journal, we credited cash for $2,000. Now here's where we get to really analyze the balance. The balance was a $15,000 debit balance. We just credited it for $2,000. So one thing that I always kind of say is opposites subtract. I know that's a little weird, but opposites subtract. So we have a $15,000 balance debit and we just credit for $2,000, which means that we took away from that balance. It's the opposite. So we're going to subtract. So that dragged down the balance. It's still going to stay in the debit side, right? So technically, a little bit of a spoiler alert, in cash, we should never have a credit balance. But once you start getting to some more advanced accounting scenarios, there might be a chance that one of these other accounts that has a normal balance of debit might go into the credit or vice versa. But again, that's a story for a much more advanced video. And 11 posted. Let's do accounts receivable on 12/5, first page of the journal. Let me see if that's going to ruin everything if I just go ahead and do that. Perfect. First page of the journal, we just debited it for $3,200. So that's our balance. And account 12, done. On 12/5, we credited services revenue for $3,200. Let's go to services revenue. On 12/5, first page of the journal, we credited services revenue for $3,200. So $3,200 credit balance. Account number 41. All right, here we have another cash. The cash ones are more fun. Okay. So on December 11th, we debited cash for $1,500. All right. So if opposites subtract, then if it's the same, we add. So we had $13,000 in the account. We just added another debit. So now the new balance, $13,000 plus $1,500. The new balance is $14,500 debit. Posted. Let's do one here. This one's going to be fun because this is our second service revenue. So on December 11th, we credited services revenue for $1,500. So on December 11th, that was the 11th, right? Yep. J1, we credited for $1,500. Now, what would be the balance here? Well, opposites subtract, but we have the same here. So we have a credit and a credit. So we are going to add those. So we had 3,200 in there and we just added another 1,500. So the total revenue we earned for this period is $4,700 because that was our last one there. That's account number 41. Posted. All right, prepaid insurance, 1212. First page of the journal, we debited it for $1,200, so we have a $1,200 balance. Posted. Next is cash. First page of the journal, and we credited it for $1,200. All right, so we had a debit balance of $14,500. We just credited it for $1,200. So remember, that's a debit and a credit. So are we going to add or subtract that credit? It's the opposite, so we are going to subtract. Posted. Let's go to supplies, 1215. First page of the journal. We debited it for $600, and that's it. Next one is going to be accounts payable, first page of the journal. And that was for 600 credit. So the balance is 600 credit. 21 posted. And we have another cash, 1219. See, once you start getting into this, it can get rather comfortable, in my opinion. But always be careful. A little tiny math error could throw anything, the whole thing off. So be careful. So we had a balance of 13,300 debit, and now we're debiting it again. Remember, a debit and a debit, we add. So that brings our balance to 14,700 debit. Posted. Accounts receivable. Here it is. On 1219, first page of the journal, we credited accounts receivable for $1,400. All right, here we go. So we had a debit balance of 3,200. Now we just credited it for 1,400. So are we going to add or deduct that credit of 1,400 from the debit balance? It's the opposite. So we are going to subtract. And that leaves us with an 1,800 debit balance in accounts receivable. Accounts payable. This one should be fun. 1221. First page of the journal. We debited accounts payable for 500. Remember, this was us paying off something, right? All right, so here's our first credit where we get to update the balance. So we have a credit balance of 600, and now we have a debit of 500. So remember, opposites, subtract, but it's still going to stay on that credit side because we have more credits than debits, right? So we had a $600 credit balance. We had the opposite debit, so that's going to take away from the balance. So we have a normal 100 credit balance here. And thrown, posted. And 1221 on the first page of the journal, we credited cash. We have this nice little debit, credit, debit, credit, debit, credit kind of thing going. All right, so we had 14,700. We just credited, so we are going to have to subtract that $500. Okay. Posted. Utility expense. Let's see, that's 1224, 350 debit. 1224, first page of the journal, 350 debit, 350 debit. And that's it. All right, now for our second utilities expense, I'm going to add an extra line to our accounts payable because we technically need an extra one here. All right, now it's ready for us. So 1224. On the first page of the journal, let's see, we credited accounts payable for 350. So we had a 100 credit balance, and now we credited it for 350. So remember, a credit and a credit, we are going to add that to the balance. So now we owe a total of 450. Accounts payable 21, posted. for the drawing account. Oh, right here. 12/31, first page of the journal. 1,000 debit, 1,000 debit. And then last but not least, 12/31. We paid cash of $1,000, so 1,000 credit. Oh, 1 second. Bad. 32. Posted. All right, back to cash. So on the end of the month, first page of the journal, we credited cash for 1,000. So we had a $14,200 balance. This was a debit. We just credited, so we just took away from the balance. 13,200. Posted. Beautiful. All right, so now what we're going to have to take a look at is next step would be our trial balance here. Delete these so we do it from scratch. Now, the one thing before we kind of move on to step 3 where we're creating this unadjusted trial balance, I just want to talk a little bit about this general ledger and these balances that we're seeing. And this kind of relates back to this LC figure that we have here. Notice that assets increase with a debit. So for all of our assets, we should be seeing a debit balance. Debit. Remember, assets are the 1. Debit. Here we get to 2. So these are liabilities. Liabilities increase with a credit. So our liability accounts should have a credit balance, right? Capital increases with a credit. Drawing is a contra capital, so that one's special. Remember, the signs flip, so debit. Revenue income is credit, and then expenses are debit. So one thing I want you to keep in mind as you're going through the ledger, if any of your asset accounts going to the credit side, at least at this level, something went wrong, right? So assets have a normal balance of credit. Debit, so they should stay on the debit side. Now, there are some more advanced ones that you're going to see later on where those rules might not stay true, where they could have a debit or credit balance, and it really doesn't indicate that it's a big deal, especially at the unadjusted trial balance level. But at this point, normal balance for all assets and expenses are debits. Normal balances for all liabilities, capital, and revenue accounts is credit. So just keep that in mind. Now, our last step is going to be this unadjusted trial balance. Here, we are going to be basically comparing what we have here. Make this just a little bit smaller. We are going to be comparing what we have here in each account, and we are going to be kind of transferring that final balance over to the debit or credit column for this unadjusted trial balance. So for example, let's grab cash's balance. So cash had a balance of 13,200 debit. So let's put 13,200 in the debit side. Accounts receivable had a balance of 1,800 debit. So 1,800 on the debit side. Supplies, let's just go up a little bit, had a debit balance of 600. Prepaid insurance had a debit balance of 1,200. Accounts payable has a credit balance of 450. Capital has a credit balance of 15,000. Drawing has a debit balance of 1,000. Services revenue has a credit balance of 4,700. Rent expense has a debit balance of 2,000. And then utilities expense has a debit balance of 350. Now, if you were to get to the end of that and your debits did not equal your credits, that is a great indicator that something went wrong. Either a journal entry was incorrect or you did some incorrect math over here or something, right? Just because they equal, it's not a 100% guarantee that you did everything perfectly. There could still be mistakes, but if they don't equal, you know something is off. These must equal. Okay. So I hope you enjoyed this. If you have any questions, please feel free to leave it down in the comments. I'm also going to be leaving links to several other resources that can give you additional journalizing, posting, and trial balance practice. So please be sure to keep an eye out there. And if there's anything else you want to see, please let me know in the comments. So Until next time, keep up the great work, everyone, and happy studying.